Kalpen there?
No, he needs to join.
Hi everyone, good morning. We are waiting for Kalpen to join, so we should be able to start in next couple of minutes time. Thanks. Hi, good morning, everyone, and welcome to today's webinar. My name is Vaibhav Porwal, and I'll be your host for today's webinar. A big thanks to everyone who has joined us today morning and took out time from their busy schedule. What we'll do today is to discuss about importance of portfolio review. And portfolio review, in my mind, is an important aspect of the entire investment process. Uh, you please feel free to ask questions in the Q&A window, and we'll try and address them as we go along. The person who will be joining me today for this interesting webinar is Kalpen Parekh. He has been my friend for last 20 years and is currently serving as MD and CEO of DSP Mutual Fund. He'll be joining us any moment and we are just waiting for him. Just give us a minute's time and we'll get this started.
Can you just send me the webinar?
Hi everyone, sorry about this delay. There is some connectivity issue at Kalpen's end and we are trying to resolve that quickly.
Vaibhav, can you hear me?
Yeah, hi, Kalpen. Finally, we can hear you.
Hi, I'm so
But we
sorry
can't see
about
you
this
yet.
to all of you for 1 second. Um, can you see me now?
Yeah, absolutely.
Okay.
Hi, good morning, Kalpen.
Good morning to you and to all of you. I'm sorry for the delay. Took me a couple of gadgets to try to sort out and finally log in.
Yeah, tech can be funny sometimes.
Yeah, I know
Thanks.
you guys were trying since last half an hour, but I was a bit confused because I started my computer after almost 3 weeks, so everything was getting downloaded. Yeah.
No, great to have you here, Kalpen. And we would like to welcome all our participants for this webinar. We discussed this briefly, and you know that we are going to talk about the importance of portfolio review. Uh, in my mind, portfolio review is an important aspect of the entire investment process. And there are three different segments that we want to focus on. Why investors should review their portfolio, how they should review their portfolio, and who should help them review their portfolio. So, any initial thoughts, Kalpen?
Weber, see, we are all busy professionals or business people with core competence in our day jobs or our businesses. And in the last 5, 7 years, markets and asset classes have started moving much faster than ever before.
Yeah.
So in old days, we could just say that, buy and hold and, things will just continue to compound. And that partly remains true even today also, but asset classes are moving almost like doubling in 1 year or 2 year at times, and then correcting by 30-40%. So the need to not necessarily act frequently, but review your portfolio in a scientific and calibrated periodic manner is very important. And there has to be a science around it, there has to be a framework around it, because review is not just looking at the portfolio, but then do what, and what should be the turning points, or what should be the boundary conditions at which you then decide to act. So there are many nuances to understanding how asset classes and prices are moving, how your portfolio is progressing. And I think they're working closely with good partners and advisors like you, who have a scientific method, becomes very important. So that method is very important. The science and discipline around that method is very important, and the need to review also is very important.
No, thanks, Kalpen. This is quite interesting. And what I found interesting about your portfolio, which you published and mint recently, was the kind of diversification that you use. And obviously, one thing which intrigues me, and I've known you for more than 20 years, is how your portfolio construction would have changed over time. And what are the parameters that you considered?
Okay, so the type of question you're asking will actually reveal to the audience, very poor investment decisions that I've taken in the first 8, 10 years of my career. And I want to, in all honesty, admit that that uh, learning about markets is a ever continuing process. You never know it fully, and while sound principles or first principles remain intact forever, but the approach to investing has to evolve and adapt with your changing needs and with changing landscape, changing market dynamics. So I think I was a very poor investor till 2007 and 8. And I started my career in 98. I started with a very fast moving tech bubble, when within a year stocks would go up 2 to 5 times. So there was always this illusion that making money is very easy.
Yeah.
So that was the first early experience. And then I saw 80% correction in tech stocks or NAVs of technology funds, where I just started my career with. And then you saw a mother of all bull markets between 2003 to 7 in India. We always keep comparing. Even today, you will hear a lot of experts and analysts and people comparing to that glory period of India. But I just want to make it clear that that was a one-off period of extremely fast returns, where in 4 years markets, Nifty went up 7 times and small cap index went up 15 times. And it was coupled with a 40% price appreciation, 25% earnings growth, country growing at 10% GDP, and all of that. So these were some aberrations which we started believing is the norm. And hence my portfolio started looking very skewed to what was the fashion of the season, what was the most popular stock or the sector or the fund of that season. And whatever I would do, at least in the next 6 months, 1 year, would make money. So you get an illusion that you are a hero. I didn't need anyone's advice, or there was this arrogance that abhi to sab pata, we have arrived. And then 2008 happened, when everything collapsed by 50 to 70%. Market itself fell by 57%. Bad stocks fell by 95%. Some of the stocks in my portfolio have not recovered. So 100 became 90, 100 became 50, and then 50 fell another 50% to 25, and 25 fell another 50%. Today, some of them are at 1 or 2 or 3 rupee price, and they've never recovered. So that is when I realized the value of a few things. One, having a diversified portfolio. so that one asset class does not pull down everything.
Yeah.
The second learning I got is respect quality and valuations of your asset classes. I'm not talking of only equity or stocks. I'm saying of the asset class. So in fixed income also, there are bad fixed income bonds and there are good fixed income bonds. In equity also, there are good companies and bad companies. And then the second point is respect valuations. Don't overpay blindly. So I think with that journey, realized the role of diversification is very important. And once in few years, when I rebalance towards an asset class which is reasonably priced and which has the basic drivers of either defense, which is protection depending on my needs and cash flow, or drivers of growth, which is coming through owning businesses and equities. And lastly, I always say this to myself and to all the friends and people who ask about investing and view. Nassim Taleb has made a very powerful statement that he says, "Don't give me your view. Instead, show me your portfolio, because that is a real manifestation of what the view is." So, which is why I started, talking about actually what the portfolio is. And the disclaimer here is, this is not an ideal portfolio. This is my portfolio. This does not necessarily have to be your portfolio. So, if there are 247 participants today, there can be 247 unique portfolios. And that's where personalization, nuancing about your future needs, your time horizons, risk appetite, and how do you respond to market fluctuations becomes important. Now, why is my portfolio diversified? Let me give this nuance also. I invest on behalf of my sister also. I invest on behalf of my parents, on behalf of my brother. Now, my brother and sister's portfolio are reasonably, growth focused or very long term focused, and they are largely in equities because they are not in this industry and they don't track markets every day. So they are unlikely to react with every stimulus. In my case, I track these things every day, and I've started my career with two sharp for 50 to 70% price corrections. And I've realized that if you encounter a 20-30% drawdown in the first year itself of your entry into investing, you are almost out of the game for the next 10 years, because compounding loss is very, very large. So that has taught me to become a bit defensive, number one, which is why my portfolio is diversified. And second, in the last few years, generally, I have felt that markets have been frothy, asset classes have been frothy, everything has become easy to make money. And hence, I've been a bit more defensive. At some point, if let's say markets become a bit more cheaper, or I find asset classes cheaper, I find selectively, let's say, international stocks, high quality businesses cheaper. So that's why you'll see 17% exposure to global stocks through international funds. So my equity exposure still is meaningful at around 65%, but more diversified and broad based.
No, great, Kalpen. You made some interesting point, and similar to yours, my journey also started like that.
We started together, yeah.
I started in 2003, and as you mentioned, that was the mother of all bull runs, right?
Yeah.
Making money was so easy. You get into the market on daily basis and believe that you know it all, and then initially you get blessed with gambler's luck also. So
Yeah,
that
that's the
also
right
happens.
term.
But over time you run out of it, and like you mentioned, you ran out of it in 2008. You took much longer to run out of it. I ran out of it much faster. But one thing which always worked for me was constantly monitoring my portfolio. It allowed me to identify the gaps which were there in my portfolio, and which really helped me in correcting some of the mistakes that I was making. And some of these learnings we have used at Dezerv to develop this tool called Dezerv Wealth Monitor. And some really interesting insights come out of that. So over last 3 months, we have reviewed almost 35,000 portfolios. On an average, these portfolios have underperformed by 5%. So that means for an investment of 1 crore rupees, you're losing 5 lakh rupees of gain every year, which is a large number, right? Uh, so obviously the parameters that we consider, and you spoke about quite a few of them. First, we look at the performance of the portfolio. Second, we look at need for diversification and rebalancing. You mentioned that periodically you rebalance your portfolio, and we can build on that. Third, you mentioned that your portfolio is your portfolio. It should reflect your requirement. And you mentioned that your family requirements are very distinct from your personal requirements. So reflection of that is also there in your portfolio. And fourth, an interesting thing, is staying disciplined in this market. So let me start with performance first. So very interesting insights we gathered from Wealth Monitor, and one of the first thing that we noticed was the way people were selecting instruments. Most of the investors were investing based on the historical performance of a fund. And every time they saw underperformance in their existing fund, they would liquidate out of that fund and get into the fund which has done well over last 12 to 24 months. And unfortunately, that created further underperformance in the portfolio. So team jokingly made this slide where they said, what if you invested 100 rupee in 2013 and every year you change your portfolio based on the best performing fund of the last year or the worst performing fund of the last year? And you will be surprised to know investing in the worst performing fund of the last year has delivered better outcome compared to investing in the best performing fund of the last year. Any thoughts on this?
So this is a brilliant point that you've highlighted, and the two decades of my investing journey
Yeah.
have two distinct parts. Before 2008 and after 2008. And before 2008, I was an investor trying to be in the blue line. Because like I said, working in the industry, having access to daily NAVs, comparisons are real time available. The mindset or no one had taught that time that when you are trying to invest in the best performing fund of today, we don't realize that it is best performing for someone who had invested 1 or 3 or 5 years back, not for the guy who's putting in today. Number one. Number two, there are cycles. So when markets have cycles, funds have cycles. So a fund which is best performing today may be a good fund for the long term, but may not be best performing for the next 1 year. Or a fund which is a worst fund today may not be worst forever because they have cycles. I used to always follow this pattern of choosing the best mid cap fund, then moving to a thematic fund, then healthcare fund doing well, and you keep jumping from one train to another, but the station is always missed. And it is in 2008 or 9 when I read The Intelligent Investor from Ben Graham, who is Warren Buffett's teacher. There is a paragraph there, or there's a full chapter, I think, if I'm not mistaken, chapter 8, which is about how should you invest in mutual funds. And there he says that there is nothing called as best performing fund. What you have to seek is to be the best performing investor, or become the best investor for your own needs, for your own personality. So a lot of these things then you have to internalize. And I think the framework that I've evolved then over time is to say that if my time horizon is for a 5 year or a 10 year period, or in my case it is probably for a few decades, because financial independence is there for me. I don't have to keep changing randomly, but I will never buy the best performing fund just because it is yesterday's best performing fund. Or even if I buy, I will be okay if it underperforms for the next year or two. And I'll give a personal experience. When I joined DSP in 2017, before joining, generally there's a protocol that as a CEO you meet your team, you meet your top league team before you come into the organization, just to familiarize. So I was asking all the different business heads that where should I when I move here, and I have this philosophy that I will invest only in those funds which I will work in, because only then I'm demonstrating skin in the game. So I asked everyone कि मेरा पैसा जो है थोड़ा बहुत वो कहाँ DSP के कौन से स्कीम से इन्वेस्ट करना चाहिए, because I'm still not very familiar. And almost everyone told me DSP micro cap fund, and that fund was rated in 2017 the best fund in the world, because its prior 4 year returns was 40% CAGR. And there was this another fund called DSP Equity Fund that time, which has a 22-year history then, and today a 27-year history, but no one spoke about it. So I was wondering, why is no one talking about our oldest fund? And in that specific period, for those 2 years, the fund's performance was relatively poor because it was not owning some set of stocks in line with its style. But I read the document of the fund manager. I read the investment philosophy. I found it, very disciplined. And I felt that, this is at a low cycle right now. I think I should start with this. No doubt, microcap is a good fund. And, it is our most marqueest fund. But at that point in time, it was already at a cycle high. So much so that we decided to stop taking inflow in that fund because we felt that space is becoming a bubble. So I'm giving you a real life example. And I invested actually in the equity fund. which eventually delivered in the next 3 years far more superior returns because micro caps and small caps had become exaggerated. So my investing framework incrementally always is that at any point in time, my portfolio should have 30 to 40% funds which are current underperformers, but where the principles of fund management are sound and the style is sound. I can do this on my own daily, but for most people, they cannot do this, and that's where they need expert advice.
Yeah. No, there's two, three important points that you made, Kalpen, and one thing which immediately comes to my mind is you don't invest for the past, you invest for the future, right?
Yeah.
When you're investing for the future, your portfolio has to be aligned with what these funds are likely to deliver in the future versus looking at how they've performed in the past. This interesting analysis that we did, where we measure the correlation of historical performance of the fund with its likely future performance. And trust me, its historical performance is not indicative of future performance. So we need to be really careful while selecting funds based on the historical performance. You also made one very interesting point, and I want to build a bit on that about diversification. You mentioned that you over-invested money to small and mid cap, and then you course corrected, which is one thing we see again and again in the portfolio. Obviously, if asset classes go through multiple cycles and each asset class will deliver different performance year after year. And you shared an interesting slide with me yesterday, and we captured that in the presentation. But before that, why is it important to diversify your portfolio? And is it important that you rebalance your portfolio periodically? And what are the factors one should consider while rebalancing the portfolio?
So actually, if I can see that slide, because I made it only to highlight the need. So I'll just quickly take these 3 slides that I had made.
Yeah.
Now, generally, let's remember that we feel like investing in an asset class only when it is more talked about as common investors. And an asset class, when it starts becoming more talked about or starts becoming more popular, generally tends to stretch towards irrational levels, or towards probably even a bubble in a cycle of a in a phase of a decade. So here I've just shown the yellow line is Nifty, and this is Nifty's return since 92 to 2003, and this is reasonably 11-year long period. And if you remember, a lot of you who have seen recently the TV series Scam, this was the time during the Harshad Mehta scam when the market had reached stratospheric levels and stocks had gone to crazy numbers. And you cannot fight the force of headlines and people around you. In those days we used to all travel by train, and everyone saying that if you are not investing in these 10 cement stocks or these 5 steel stocks, you are losing opportunity of lifetime. I remember I was doing engineering, and my friends, instead of studying thermodynamics and kinetic engineering, they were more focused on buying economic times. उन दिनों में हमारे पास इतना पैसा भी नहीं था to purchase some of these pink newspapers, but that was a type of obsession. And since 92, it took 11 years for Nifty. तब निफ्टी नहीं था, बट निफ्टी का ये रीबैलेंस डेटा है. तब सेंसेक्स था. It took 11 years for Sensex to come back to the same price. So your capital did not grow at all. And by the way, if you had invested in just a government of India bond in 92, interest rates that time were 15 or 16%. You would have earned 16% every year, which means almost 5 साल में पैसा डबल हो रहा था. तो 12 साल में पैसा 5 गुना हो गया होता. Versus that, market gives zero return. Now this is and the blue line is actually PPF. I've just taken PPF as a proxy. In those days they were at 11 and 12 and 13%. So the blue line with straight line gave 11% return, whereas Nifty gave just zero. And actually, if you had done SIPs in Nifty, which is stagger your investments, which means not putting everything at the peak, but also buying when prices correct at low cycle, you would have still made 6.2% per annum, which is nothing great in that era. But it did not at least not grow your capital. So the point I'm making is when you buy something which is very popular at that point in time, most likely it will not be profitable. Popularity and profitability are almost inversely correlated. And the next slide, if you can move there, Vaibhav, I'll quickly cover this point. Now, this is a point on, I call it diversification is a scientific financial jargon, very important. divide and rule, we have grown up saying that divide and rule nahi hona chahiye. If we, you know, which is what Britishers did to us, they divided and ruled. We need to do the same for our portfolio. We need to divide money across 3-4 sensible asset classes. I'm using sensible because people misunderstand diversification by saying that, you know, I'm invested in 20 equity funds, or I'm invested in 50 mutual funds. That's where again review becomes important.
Yeah.
Diversification has to be of has to respect two principles.
Yeah.
The underlying asset classes should be fundamentally sound, number one. Number two, you diversify only between asset classes which have low connection or correlation with each other. They move in opposite directions. So here I'm just showing you, if you see in the last decade, the purple line has trended upwards in terms of its rolling 5-year return. These are these are actually rolling 10-year returns of asset classes. Now the purple line is a US market. This is just the S&P of US. And in the last few years, it has delivered higher 10-year rolling returns than the other three asset classes, which is Indian equities, Indian bonds, and Indian equities and gold. Now, which is why today that asset class suddenly people will start chasing, which also is wrong. So what I'm showing here is that if you look at the table below, the worst that shows worst case return, median return, maximum return, and standard deviation. And this data shows that when you mix the three asset classes, which is Indian equity, Nifty, S&P 500 of US, and gold in equal proportion, the worst case return ever received is actually a positive 6%. Whereas if you had done in an individual asset class, if you had put everything in Nifty, the worst case return was 3.7 over 10 years. In US equity was minus 1.6 CAGR over 10 years, and in gold it was just 3%. So the worst case return of a combined portfolio is higher than the individual worst case return. On the other hand, the median return, which is what we are most likely to earn, is higher than the individual components of. So the combined portfolio has higher median returns than individual. And lastly, the standard deviation, which is the volatility, is the least. So when you divide and rule, broadly you earn the return closer to the best performing asset class at relatively lower volatility. And just last slide after this, conveys this in a slightly, more appropriate point. Yeah. So here, when you look at this, just combining that, why chasing the asset class of past is fraught with risk. I've just again shown here the rolling return of Nifty over a long period of time on any 5-year bucket, because most of us think from a 5-year bucket. So and the plus 40%, the rising 40% was the return between 2003 to 2008. In that period, Nifty gave 40% return on a 5-year basis. And that time it felt that all money should be in equity. That time all headlines were screaming India story, growth, and so on and so forth.
This is when I started my career. So
yeah. And then in the next phase, 2008 to 2013, and especially markets crashed by 50%, and then for next 4 years they were flat. In 2013, the last 5-year return of Nifty was minus 5%. So for 5 years, you had not earned anything. You had actually lost 5 rupees every year. In 2013, I remember if I had to talk to someone about equity, one, it needed courage in me. यार 5 साल का रिटर्न नेगेटिव है तो किस मुंह से मैं बात करूं? And second, the person on the other side would say, are you mad? Because government bonds are giving 9% return. Why will I buy something which has given minus 5? Now remember, since then, in the next 5-7 years, again, the 5-year average return has moved between 10 to 20%. So what I'm trying to highlight is that asset classes which are peaking in the past should not necessarily be very high in your portfolio. At the same time, asset classes which are bottoming in the last few years should not become underrepresented in your portfolio. And that is where, when we diversify, diversification achieves two objectives. It ensures the worst performing asset class is there in your portfolio today, but most likely that worst performing asset class will also be the best performing asset class in the next 3 years. So these are few comments on diversification.
No, absolutely, Kalpen. So two things come out very clearly. Don't chase historical returns, even either at asset class levels or at instrument levels, because in both these scenarios, you are likely to suffer significant underperformance. What about rebalancing? So what I've seen is sometimes you create a portfolio, and because of the forces of asset class performance, your allocation changes. How do you correct that? And I've seen, for example, to simplify it further, for example, if I started with 50% in equity and 50% in fixed income, over time, if my equity becomes 70% of the portfolio and fixed income goes down to 30%, how do you deal with that kind of a imbalance in the portfolio?
So it's a very important thing. One to constantly have sight of. Let's say you start by telling me that, Kalpen, for you, your right mix is 60 equity and 40 non-equity, and non-equity could include multiple asset classes. And suddenly we see a year like 2020 and 21 where markets irrationally double. So my equity exposure will rise very sharply. Now, generally, when something rises very sharply, it is prone for a slow phase or a negative phase in the future. So if my 60 rupees of equity is actually gone up to 80, 90 because it would have run up a lot, that is the moment to start asking questions that bases your goals and your risk profile and your time horizons. We had agreed for 60-40 as the right mix, but that mix has changed to 70-30 or 80-20 or 90-10. In very sharp moves, some asset class becomes very dominant, and hence there is merit in revisiting. Now, if your goals have changed at that point in time, you may revisit. But if not, it's better to normalize it back to what your objective scientific asset allocation demands. And ultimately, it is being present in the right asset classes in the right proportion. The discussion about stocks are overrated. Discussion about what will Fed do and RBI do and government do and Prime Minister Modi do, all of that is overrated. We rarely discuss about what should we do and not do.
Yeah.
And that's where the role of sensible portfolio construction becomes very important.
Yeah.
We always get carried away with 2 funds in my portfolio which would have done very well, or 10 stocks in the portfolio which have done very well, but
Yeah.
we ignore how at an aggregate basis the portfolio is moving. See, ultimately, if you are able to continue with compounding at steady rates over long periods of time, we'll end up being in the top 5% list of investors. Most people don't last. I'll give you a statistic. I'm going back to my favorite fund, which has now 27-year history. Okay, this is called DSP FlexiCap Fund. It has delivered around 18% CAGR. So the NAV would have gone up by around 75 times in this period.
Wow, 75x.
75x. Now, do you know, in these 27-year history, how many investors have stayed put for 27 years? That number is less than 27 investors who have
So
stayed
talking
put.
about 27 investors, not 27%.
Yeah, not even 27 investors would have lived through. Now, the reason for this could be many. Different investors would need to take money out at different points in time. Now, when I highlight that this fund has given 17% CAGR, 70 times growth, all of this means nothing to you if you have not stayed put or started on that day and you are still enjoying the benefit of that. So, time horizons are underrated, unfortunately. It is time which creates maximum compounding. In fact, if someone asks me that, who's your best fund manager, I will say my best fund manager is my time horizon and my discipline. Because if I give these two to my portfolio, that is how, long-term compounding and wealth creation really happens.
No, great, Kalpen, and you spoke about discipline, and I want to touch upon this aspect of investing. But before we go there, I want to remind our participants that they can ask their questions through the Q&A window, and we'll take it up as we go along. So discipline is something which is my favorite subject, and we looked at this very interesting data. In 2021, everyone was talking about only investing in equity. Fixed income returns were nothing to talk about. People wanted to invest in all the exotic asset classes without being mindful of the risk. Number of SIP registrations went through the roof, and flows into the equity markets were crazy. So what has happened over last 18 months is markets have not delivered any returns. And impact of that is starting to get visible in investors' behavior. What we are seeing now is cancellations of SIP. So if you look at the next chart, you will see the number of SIPs which are getting cancelled. 37% people have cancelled their SIPs. So there could be two factors. One, obviously, because markets have not delivered any returns, and second, because investors have other requirements. So I'm assuming in case you have other requirements, it's okay. But in case investors are doing it because markets have not delivered any performance, how should they rethink their investment process?
So, Vaibhav, I think it is a combination of both the factors. This the last 2 years was also a period characterized by very high inflation, and lifestyle inflation went up. Basic day-to-day, consumables prices went up. Electricity bills have shot up. My wife keeps telling me कि हमारा 4,000 का bill था, 8,000 आ रहा है. Why so? And so things. So to a lot of extent, some people did feel that pinch, and it coincided by this thinking that, अरे I came to this asset class, तब तो ये आपने 15% रिटर्न या 12% रिटर्न बोला था, बट पिछले 1.5-2 साल में तो रिटर्न कम हुआ है. This is again combination of all the behavioral bad decisions that generally human beings take. Past returns they we invest when they are high. Just when they again turn down, we give up, or we give up faith in that asset class. Real returns are the value of returns is back ended. The takeoff of size of money made is always back ended. So the trends that you highlighted, the numbers you highlighted, was a combination of two things. A lot of money came in, I think, without financial objectives. The only objective with which money had come in, I am saying this because in the building in which I stay, there are 14 flats, and whenever we would informally cross each other or meet each other in the lift for two minutes, the comment would be क्या लेना चाहिए, कौन सा stock लेना चाहिए. It is like कौन सी flight लेनी चाहिए, without asking कि मुझे कौन से city में जाना है. Most investments which happened, a lot of investments which happened in that easy phase of 2020, because buying stocks had become easy. Everything was digital. A lot of people were at home and had time. All of us were doing videos and talking of stocks and themes and stuff like that. So when things become easy, we also become lazy. And most money came without financial objectives, without having a reason to invest. The reason was सब पैसा बना रहे, थोड़ा हम भी बना लेते हैं. And then came a phase of just around 18 months of poor returns, and the trigger for that was overall everywhere inflation went up, interest rates were hiked, then Ukraine Russia war happened. So see, markets are not obligated to go up every day because we want them to go up. Remember, I'll give you an anecdote. In 1914, in the New York Stock Exchange auditorium, there was a large gathering of 1,000 people, and the person on the dais who was speaking was the most recognized banker of the world in its history, J.P. Morgan, because he was the guy who could move markets, he could move policymakers, he used to fund the biggest innovations in those days and stuff like that. Very, very respected guy. And he was asked this question, market kya lagta hai? English mein pucha raha tha abhi. What is the view on the economy, markets, and how do you think markets are looking? So he actually paused for a few minutes. He closed his eyes. So he was in deep reflection. And what came out of after that were just two words, which are the most important words we need to remember always. And his two words were markets fluctuate. So, we are used to hearing views about certainty. Every day it will go up. Next 1 year it will do this. PLI is happening. China +1 is happening, and so on and so forth. All of that will happen, but that does not mean markets have to keep rising, because there are different types of passengers in this train. Some people have to get down because unka next year mein station aa gaya hai. Some people have to get down in next 3 months because they need to buy some asset class. Some people are coming in. So the force of inflow outflow keeps changing every day. Fundamentals keep changing every day. Businesses go through cycles. Banks were the worst performing sector between 2017 to 20, when their balance sheets were going through a cleanup. Banks are the best performing sector in the last 1.5 years, when after they cleaned up their balance sheets. And in the next 10 years, when will NPA cycle start again? When will it stop again? These are very difficult things to predict. So fluctuation is not a bug. It is the feature of investing. We have to embrace fluctuations. There are great techniques available how to take advantage of fluctuations. Let me add one data point. I don't know if I had made that chart of Nifty and gold, and to highlight the combination. So
I don't think so.
okay, no worries. So let me ask this question, and you can answer this on behalf of everyone. What is the average of 11 and 12, Vaibhav?
It's 11 and a half,
It's
obviously.
11 and a half. Now, over the last 25 years, gold as an asset class has earned 11% returns. Nifty as an asset class has earned 12% returns. So if you had invested in these two asset classes only,
Yeah.
50-50 equal weight, we would assume that our final return should be 11 and a half.
Yeah.
Actually, you'll be surprised to know that the blended return today is neither 11, is neither 12, is neither 11 and a half. It is actually 12.9 or 13%. So the average return is higher than the individual return.
Has
And
it gone up because of rebalancing?
it is only because of rebalancing. So because when fluctuations happen, and these two asset classes have very poor correlation. Generally, when gold rises, equity falls, or when gold remains constant, equity rises. So what happens is at the end of a year, when equity has run up a lot, your portfolio gets skewed. And then if you advise that now let's take some money off and move to another asset class, which is gold or fixed income or something else, you are buying, you are basically selling high and buying low, and which is the primary rule of compounding in a more sensible way. Most of us end up buying high and selling low. The chart that you showed of chasing the
Yeah.
best performance, yet that giving you poor return uh, is mainly because we buy high and we sell low.
Yeah.
So I think rebalancing is a very powerful force. But the point I was making is rebalancing is valuable only if asset classes fluctuate. If it
Yeah.
is a straight line asset class, there is no need to rebalance. So fluctuations need to be made our friends, rather than chasing the best performing asset class, or just looking at forecasts.
So in summary, rebalancing is a great way to add returns to your portfolio. And this flight analogy is a great analogy. You need to decide where you want to get off.
Absolutely.
Interesting for you. And I was going through that Mint article where you mentioned that you bought an apartment after 17 years of working or 18 years of working, and you kept postponing that decision forever. Why did you postpone that decision? And how did you change your portfolio when you finally decided to buy that apartment? Well, that's
Okay.
where our next question comes in. Should your investment objective or financial objectives dictate your investment portfolio?
So I'll start by saying that it is clearly the financial objective which should be your first parameter to determine the portfolio. If I know that during this health and life crisis that we went through in COVID, I had many senior relatives, family members, elder family members, where the husband was investing on behalf of the wife, and the husband passed away, and suddenly the wife realizes that I have 5 crores in a fixed deposit. Now I want to invest that money, and I'm giving you a real life example where she would say that आजकल सब equity में पैसा लगा रहे हैं, तो मेरा भी थोड़ा आपके equity fund में लगा दो. And the first thing I would show to her is a chart that there are phases when in 3 and 5 years also equity returns were negative. Will you be able to digest that? And the answer was no. So financial objective and your risk appetite should determine how your portfolio should look like. You spoke about apartment. मुंबई में तो apartment बहुत मुश्किल होता है. छोटा सा घर लिया मैंने, and the reason why I took after such a long period of time is that we all know that the cost of real estate is obscene in Mumbai. For the type of infrastructure and environment around us, 40, 50, 70, 80,000 rupees per square feet. Even some of the most developed cities in the world have cheaper real estates. So I always felt that this is not sensible, that you are overpaying for an asset class some crazy amount. This was an emotional comment.
So valuation was the criteria for you.
Valuation was an important criteria, and the mathematical way to judge that valuation was that, and then being blessed to start my career in the fund industry, over time you knew that kitna return ban sakta hai. So if I would do nothing and just buy my simple short-term debt fund, let's say on an average the return would be 7 to 8% tax free, without any झंझट. 24 घंटे में पैसा वापस आ जाता है, liquidity है, no extra costs. So, and versus that, the rental yields in Mumbai were around between 1.5 to 2%. So the idea was that continue to live on rent by incurring a cost of 2%, and let the savings that I am gradually slowly accruing through my career and professional compensation, let it go to growth asset classes, through a combination of fixed income and equity, and helped me in building a certain size and kitty. Secondly, I generally am too conservative to not think of having I don't like if there is a loan on my books. So I don't even use credit cards, which is a very extreme. I'm not saying that is how everyone should behave. There are advantages also. So the concept of loans didn't appeal to me. So I didn't want to lock too much capital, and the valuations were not sensible. During the time of COVID, there was a different reaction. So this was my evolution as as a member of the family, saying that all this while I've crossed 48 years on Earth, and I still don't have a decent house because COVID में बहुत सारे interviews ऐसे होते थे, and I could see the quality of my walls and the cracks on it through the videos, not by knowing, but the video would show that I think things need to be repaired. So it's better that it's time to
I
start.
need to meet your wife to convince my wife.
Yeah. So that was the starting point, and then post COVID, what happened is stock markets went up higher than what I personally felt it deserved to be. So I my equity allocation went up far higher than what I am comfortable with for the current valuation range,
Yeah.
and hence I felt there is merit. I anyways wanted to buy a house, had always been a part of my plan since last 18 years, and equities were expensive. So I thought it makes sense to book some profits. Real estate was, correcting in the phase of COVID. So I just did a swap in a way, sold some of my mutual funds and bought a house. And within what I sold in my mutual funds, I sold those schemes which were best performing at that point in time. Most people would sell the schemes which are not performing the best, but I sold what was doing a lot better. Because again, taking advantage of that fact that when something is becoming best performing, generally best does not remain for long, and the worst also does not remain for long.
That's a great point, Kalpen. One other thing which comes to my mind, and you touched upon this point initially, where you said you need expertise to be able to review these portfolios. Why would you say that? And investors have an option to go to AI now. They can go to Chat GPT or they can go to Google Bard and ask these tools to review their portfolio. Why do you think experts are so important in reviewing your portfolio?
So first, with all disclaimer that if people don't come to experts like you and me, then our salaries will get affected. So take this with a pinch of salt. A barber will always say that you need to cut your hair.
But do we justify our salaries?
Yeah, but that apart, I genuinely feel that the role of experts, one, should not be overstated or underrated. um, Experts also will have to evolve. So yesterday only I sent to my investment team that in the last 10 days Chat GPT has started creating a portfolio,
Yeah.
and they've completed 1 week of deploying money basis the Chat GPT recommendation. And they've also given that in 1 week we have beaten the market by so much percentage, and now in the next week we are going to change the portfolio. So who knows what technology will do? Because see, my view is that all these intelligence systems are able to take a rocket from Earth to Mars or
Yeah.
to Moon with amazing amount of precision. So there is something to learn from them, no doubt. But what happens is that in that journey, um, in markets and investing, there is a human element. The human being has changing goalposts, changing emotions, changing behavior. uh, the machine cannot completely model for that. The machine may be 75% able to model, but that human touch still becomes important. So I come from that school of thought that we should learn and leverage everything that technology can help us do a better job. But the human dimension is important to understand, to empathize, to hold hands, to guide. And this is needed typically at extremes. When markets become euphoric, the human element of advice to say that don't get carried away, because you're now starting to buy risk in your portfolio. You think you're buying returns, but actually you're actually purchasing risk. On the other hand, when things turn bad, you gave an example: 30%, 37% SIP is getting cancelled. Actually, from the time this cancellation happened, the next 1 year return is 18% positive. Now, if someone had guided those cancellations which were going out only because last 1 year return was poor, that don't worry, this is a short phase. Over time, markets generally recover. So that is the value of advice. And if good advice can add even 1% more to an investor over a 20-30 year period, it is a huge shift in the total wealth that an investor will have. Now, if someone can do it on his or her own, by all means, you should do it. But there should be confidence that you're doing the right way. Most of us think we know how to do it, but if the principles of understanding markets and asset classes and portfolio construction are not well studied and not well experienced, then it is an illusion that I know how to do this. So that's why I believe that the role of honest advice is very important. Many times honest and advice don't go hand in hand, but our industry is blessed to have many good professionals, and one of that is your group of talent which have come together after 20 years of working in large organizations. So there is a lot of good advice available today, and with the right intent, where your intent starts by first principle of keep investors first. So if you are able to identify such advisors who are thinking from your interest first, I think that's a great partnership to build.
No, absolutely, Kalpen. And we also use both of these aspects, technology and human intelligence. Human intelligence, as you rightly mentioned, helps us understand individual requirements and bring in the emotional aspect of investing. And technology helps us understand the different micro and macro parameters and how they are evolving. Great, Kalpen. A lot of questions have come, so maybe it's time we start taking some of them.
Sure.
So very interesting first question that I want to take. Someone has asked me, and which is really pertinent, is most of these learnings are based on historical evidences. All these explanations seem easy to arrive at, but what is the guidance for the current state, and what to look at, and what options to have to mix around?
So it has taken me 20 years to know what to look at and what to keep. It's very difficult to explain in 2 minutes. And of course, a lot of this is basis historical learnings and constant observations, because we have to keep observing patterns and trends and how things change. But let me tell you that the first principles don't change. The sound principles or basic principles of investing don't change. And what are these basic principles? When we are investing, and then I'll tell you from there's three asset classes that are a large part of my portfolio. I have equities, Indian and global. I have bonds, mainly Indian, and I have a reasonable amount of gold and gold bonds. The first two asset classes have cash flows. Equities give dividends, and their profits keep generally growing over time. So they have annual cash flows to dividend, and there is growth. So that is why it is a sound asset class. Fixed income does not have growth, so to say, but it also has coupon or income coming every year. And gold does not have any income. But equity and debt, unlike gold, can be printed. Companies can issue new equity. So when a lot of equity gets printed, the value of equity generally comes down. So that is why typically when a lot of IPOs come in the market of new age companies or old age companies, whenever there is supply, generally markets, in those years come down or consolidate. In fixed income and bonds also, in today's world, governments can just press one button and print the next 100 billion, supply in bonds. So they are infinite in supply, and which is why their prices can come down or fluctuate. Gold, to a large extent, has been finite in supply over hundreds of years. So my principle is very simple. I respect the asset class should be good, and the price at which I buy also should be good. A bad asset class I will never buy, even at a good price, because it doesn't deserve my hard-earned money. A good asset class I will not overpay by buying at crazy valuation. So iPhone is a great phone. 50,000 से 1 लाख के बीच में मिलता है तब तक ठीक है. मैं एक बट उसका अगर वैल्यू 3 लाख 4 लाख हो जाता है, in my mind, then I will not overpay. And I'm telling you my framework. You can feel free to completely ignore it. So the two principles are good asset class at good prices. If prices are irrational, I will rebalance. So I think these are the two principles which have worked at least over 70, 80 years of known history of markets. Markets की history 200 साल की है, उसमें documented history 100 साल की है. In these 100 years, these two principles have mostly always worked. Companies which have grown profits at X percentage, let's say 15% or 12% over long periods of time, or have 12 to 15% or 20% return on equity, they've delivered 12 to 15% profit, returns over 20, 30, 50, 70 years globally and in India. So this principle is unchallenged so far. It has always worked. Now, such companies, if you pay 100p for them, then it is our mistake, not the mistake of the company. Because let me give an example. In the year 2000, technology was the hero. Like in the year 2020, Nasdaq became the hero. Uh, Nasdaq itself was at some 60, 70p. Infosys and Wipro as companies were at 100 times profit price to earning. So for 1 rupee of profit, we in a year we were willing to pay 100 rupees. We were buying in a way the next 100 years of profit on in that 1 year. We were assuming कि ये company का 100 साल का profit आज के आज बन जाएगा, which was irrational. Now, from 2000 to 2008, Infosys continued to grow its profit at 40% CAGR. 40% profit growth is not easy. I run a business, 15% profit लाने में I know how difficult it is. So it was great compounding, but the stock gave zero returns because all the returns had got upfronted. So, in very simple terms, I'm saying what I've been able to condense my learnings over 25 years and whatever I've read across the world markets. Your asset class has to be sensible, and the price at which you add it in your portfolio should be sensible. If price becomes irrational, you should rebalance. If asset class becomes a bad asset class, you should rebalance. If you are investing in the bond of a company and suddenly the company becomes a bad company, there is a governance issue, you realize that there was some accounting fraud, even if the price is cheap, get out. Take example of some of the banks. Let's say Yes Bank was a marquee bank just because the numbers were looking great on the stock market. And then when the first round of bad news started coming in, it fell by 50%. There are so many investors who bought. Actually, the retail shareholding of this bank doubled when the stock fell down. But it kept on falling, falling, falling. So just because something is falling or becoming cheap in price does not mean you should invest. Let me give you a last statistic. I'm using one example of my fund, not to promote, but so we have a fund called Small Cap Fund. It buys small market cap companies, but fundamentally very sound companies, good governance, good management, good ROEs, and all of that. This fund has been there for now 18 years. It has delivered some 16, 17, 18% very good returns, very high quality returns. It has got around 4 lakh investors, right? Just 4 lakh investors. Now, we did an analysis of the stocks in the listed market where that stock has more than 10 lakh retail shareholders. And most of the names which came were Suzlon, Yes Bank, DHFL. So these were the type of companies which have 40 lakh shareholders. 40 lakh shareholders ने इन सब companies में पैसा लगाया है because they saw that the stock which was at 100 rupees became 50. So अब सस्ता है तो पैसा डाल दो, पैसा बनेगा. Now, forget, I'm not talking with hindsight that last 5-10 years these companies have collapsed or not made money. You just look at their return on equity. The way they let's say they were running business, the ROEs were less than 5% or 7. They were not even beating fixed deposit in terms of their ROE. So now such companies, people go and blindly buy just because either they were rising very fast or they were falling very fast. So if you ignore all this external noise and the greed inside us and stick to sound principles don't change. So I don't mind looking at history to refer back to, because this history generally remains intact. So I think that is the point, the way I would respond to this.
No, that's a great framework, Kalpen. Buy something which is available at reasonable valuations, but don't buy something which is available at reasonable valuations if it is a bad asset class.
Absolutely.
There are many, many questions which are coming on portfolio reviews, and I'll request our team to reach out to you. And in fact, we are going to release a special link to review your portfolios, and that link will be available to all the participants over next 24 to 48 hours. 2, 3 other questions which are really interesting. One is, if discipline is required for success, why do we need to rebalance chase funds within a specific class of investment? I have this. I strongly believe in Howard Marks, and he once told this thing that markets go through cycle, and it's a fact. And that for me is the biggest reason for which people need to rebalance. But Kalpen, any thoughts on that?
Okay, so Vaibhav, I would just add one more point to that. Whether to rebalance or not is going to be a function of temperament of the investor and his future cash flows and stuff like that. But at least one should review. Then you decide whether you want to rebalance or not. But review should be definitely periodic. And again, like I said, my approach to rebalancing, because rebalancing involves an action. My approach to rebalancing is that if an asset class gets drunk, I don't want an irrational asset class. So even if my returns are looking very good, but they may tomorrow just come down by 20-30% if that asset class or that stock or that fund has reached irrational levels. And it is our duty not to have anything irrational in our portfolio. So once in 5-10 years, asset classes do become irrational. For example, when let me give an example. The interest rates in USA were at 12% 30 years back. They came down to zero. Now 12 was irrational. It was a time to buy a lot of long-term bonds, and zero also was irrational. When it was zero, when interest rates go to zero, people who are borrowers, it is a brilliant time for them to raise long-term debt. So the government of Austria launched a 100-year bond around 2 years, 3 years back. So it is great for them because they are getting 100-year money at very low interest rates, and there were so many other central banks and intelligent investors who also went and invested because they said कि ये 1% पे raise कर रहा है, if one goes to 0.5 we will make capital gains. But today that bond is down 57% in capital. Imagine a bond, a sovereign bond falls 50% because it was bought at irrational prices. So I think my view is that I would rebalance, and in fact, rebalance and review is a part of discipline. If you after your review you realize that broadly conditions are orderly, prices are orderly, there is nothing irrational. No doubt in the long term the asset class is going to rise, but it is not irrationally priced. You have a choice not to take any action. But reviewing is in my view very integral. It is the other side of the coin of discipline.
No, absolutely. And by rebalancing, we never mean that you have to trigger an unwarranted action in the portfolio. Rebalance, because rebalancing allows you to correct the excesses which have got created in the portfolio. And it's a great risk management tool also.
I'll add one more point. Yesterday in my yoga class, my yoga teacher told me that you know your right hand side of the body you are using it more because it is like not because it is strong, but because your left hand side is weak.
Yeah.
And which is why you are more and more using the right hand side, which increment is adding to the weaker side of the left hand side, which means today when you're doing your asanas you need to spend more or
time,
invest more or give more energy and attention to the left hand side so that you bring the balance back. So I think balance is very important in everything, whether in breathing, whether in how we conduct our day, and likewise in our portfolio.
Great, Kalpen. Will take one more question, and which is an interesting one, and it's related with what you mentioned earlier. When you decided to buy your house, you sold the best performing funds. So there is a question which is related with that. If a fund is underperforming, how long do we need to hold the fund before moving out of it?
Okay, so my this is my personal approach again, and in my case, I have that extra advantage of understanding my funds or my fund manager and how we take those decisions. In my view, I have rarely got out of an underperforming fund because I have rarely invested in a fund which does not have sound principles. So I'm again using these two words, sound principles, again and again. That if the fund's philosophy is well articulated, and if the fund manager is deploying that philosophy very well, and yet if he's underperforming for a year or 18 months or 2 years, I'm fine with that because I understand the reasons for underperformance, and I'm willing to be patient. I am a very patient long-term investor. And because my portfolio is diversified across three styles of fund managers, generally what happens when one style doesn't do well, it is complementing the two other styles which are actually compensating by doing reasonably better. So it does not pinch me in an aggregate portfolio basis. But I'll tell you, when have I exited a fund midway without the need for that money, or even without the need for rebalance, where I felt that the style of the fund manager is not matching what he's saying. So if he said that I believe in ABC, but in his execution I realized it is not ABC but XYZ. Um, or if the fund manager is changing the risk profile compared to what the risk profile. I'll give an example. There was a fund manager who also is a very close friend of mine, and I've learned a lot from him. One of the best fund managers probably that I've worked with, and he built a very successful fixed income portfolio by taking very astute interest rate views. So the portfolio was largely sovereign and AAA, and he was able to navigate across cycles very well. And I had a lot of my money and parents' money in that fund. Uh, in his wisdom and judgment, and which which was proven right also for the next few years, he said, "Now I want to introduce certain credits in the portfolio because the credit spreads had widened, and versus a sovereign bond, that corporate bonds were giving 2% more returns." So he said, "In this cycle now, I will introduce credits also in the portfolio." That was slightly, different than my ideology. So I'm not saying his decision was wrong, but it was different than my ideology. My view was I don't want to take credit risk on a bond portfolio. I rather enhance my return through equity risk. So I am a believer of generally sovereign portfolios. So because that was a tweak, I said that then let me gradually get out of the fund, and especially I was in that fund for 10, 11 years, so taxation was not so much of an issue. So those were the instances when I thought of getting out, when the mandate of the fund changed differently from the mandate I wanted for myself. That fund still did well, so which is fine, but the mandate was very different. So there are so many nuances that you need to look at for your decisions.
Yeah, absolutely, Kalpen. Really, really interesting insights. What I gathered from this conversation is you need to periodically review your portfolio, and experts reviewing your portfolio can help add anywhere between 1 to 2% to your returns, and which becomes a sizable sum. Really enjoyed this conversation, Kalpen. We still have a lot of unanswered questions, and we'll try and reach out to all of the participants and respond to their questions. Any closing note, Kalpen?
So we believe in two principles at DSP, and these are life principles as well as investing principles. One is be good and do good. Um, uh, to your money. If we are good, we will earn money, and if we invest it right, it will do good to us. And to make our money do good to us, we have to invest for good. So that is another line I always strongly believe in. If you were doing this video from my backside, we have a hashtag invest for good, because my last line is that the best fund manager is time more than X or Y or Z. We try to create personalities out of human beings. I've also done that, but over time I've realized process should be the personality, time should be the hero, and our discipline. So my quest always has been, I don't want to chase star fund managers. I don't want to chase star funds. I want to be a star investor. So I think if we are able to internalize that the process is the hero in this journey of investing, not personalities, not experts, not authorities. Respect the process, learn the process, and stick to the process.
That's quite amazing, Kalpen. Thanks, Kalpen, for taking out time, and thanks our viewers for taking out time this Saturday morning and joining us for this webinar.
Thank you. Thanks, everyone. Have a nice weekend. I'm sorry once again to keep you guys waiting for the first 10-15 minutes.